Of long-term securities, and we are at stock valuation, part number 1 of that lecture. So stock valuation or the shares valuation. So before moving ahead, we should know that what is stock. We should have a clarity about stock. Remember that stock is also known as equity. Also known as equity. Now, what is equity basically? If you remember what we discussed in the bonds lecture, we discussed about the debt, and other terms is equity. What is the difference between debt and equity? Remember, if for example, if you wanted to buy a car having a price of 2 millions or 20 lakh, how much? 20 lakh or the 2 millions price of the car, and you wanted to buy it. For example, you just have 15 lakh in your pocket. You have 15 lakh in your pockets and 5 lakh you are asking for a loan. You are asking for a loan. So that 5 lakhs become your debt and these 2 millions are your equity. So what we are saying that stock is also known as equity. It is a security that represent ownership of fraction of the corporations. That basically tell us the ownership, how much a firm has. This is known as stock. If we talk about its types, so we have basically two common types. Number one is common stock. Number one is common stock and the other one is preferred stock. Now, what is common stock? Common stock is a type of security that represents the ownership of equity in a company. It's a very easy to understand that your participation, your percentage of ownership within the company, if a person holds the common stockholder, this is known as, or you can say in easy word, this is a common stock. So what kind of things a person has if they have a common stockholders? Number one, they have a ownership. Okay, for example, if you have 50 lakh shares in a company, so you can say I am owner of 50 lakh in that company. The other one, they have a voting rights. Whenever there would be an election for the selection of the CEOs, the people who hold the common stockholders, they have a voting rights. Voting rights to select their desired CEOs. Other one, they could transfer their rights or transfer their ownership to anyone they want. The number fourth is entitlement of the dividend. Although they are owner of the firm, but at the end they will also receive dividend. Okay, so these are some basic function of the common stockholders. Now, if we talk about the preferred stockholders, so preferred stockholder opposite to common stockholders, they don't have any kind of a participation other than their investment percentage. Okay, and investment percentage, they will just receive whatever the company made a promise with them. For example, if you invest in a company and company made a promise that they would give you, for example, 15% on your investment. How much? 15%. And at the end of time period, you would receive that 15% and you are free from, and you don't have any kind of a participation in the any kind of a company's activities. Okay. So first, if the people who hold them, what kind of a characteristics and what kind of a feature they would face? Number one, preferred, as name suggests, preferred in fixed dividend. Number second, they don't have any kind of voting rights. Number third, whenever company is in a position to liquidate, for example, company want to sell, what they will do, whenever they are in a position, they first pay to these people, to the preferred stockholders. So you can say liquidation preferences. Liquidation preferences. If we talk about some of its feature of the common stockholders, so what kind of features we have? Features of preferred stocks holders. So what kind of things we have in hand? The number one is cumulative. Cumulative. What do you mean by the cumulative? Preferred stock which all past unpaid along with the current dividend must be paid before dividend can be paid to a common stockholders. For example, you invest in the company and company said that they will pay you dividend, for example, in 2021. You are investing in 2022 and company said we will pay you in 2021, and due to any reason company was not in a position to pay the dividend in that particular year. Same in 2022, company again in any kind of a crisis and were not in a position to pay you in 2022. What they will do, the dividend of this year plus dividend of this year, company would pay you in that year. Okay, so what we are saying, because of that feature, so that becomes cumulative. Company will pay you all the year's dividend in that particular time period. Okay, that's why we are saying that that's become cumulative. Other one is non-cumulative. What do you mean by non-cumulative? Non-cumulative preferred stock which past unpaid dividend do not accumulate. The people who don't have a cumulative feature, if in any kind of a years, for example 2022 is missing, company will not pay you next year. That are the feature we have in different kind of stockholders. The third is callable feature. The third one is callable feature. It allows the issuers to retrieve the shares within a certain period of time and specified date. For example, company issuing their shares, so company has a rights that they can call it back from from their investors. For example, it's everything written on their agreement. For example, after 5 years, company will say that they will call it back. Company repurchase it again. Okay, company repurchase that shares. So that's become the callable feature. So this is also may happen in the preferred stockholders. Number 4 is conversion feature. Conversion feature. What do you mean by the conversion feature? It allows the holders to change each share into a stated number of shares of the common stockholders. Depends on the situation. In that feature, holders may enjoy both kind of a stock. For example, if company asks you that if you buy preferred stock for 5 years, let's say 50% of the preferred stock would be converted into common stock. So in that position, what we are saying that the person who hold them would enjoy both kind of stocks. So that this is known as conversion factors. So if we talk about the general types of the shares, the company may issue types of shares firm can issue. Number one is authorized share. Number one is authorized shares. Now, these shares of the common stock that firm allow it to share, they share it according to their standard, according to their desired, according to their laws, according to their rules, whatever they want. This is authorized shares issued by a firm. So that's why we are saying that it is the authorized shares. Number second, outstanding shares. Outstanding shares. The shares which are already issued. Or you can say available in the market. Available in the market, they are known as outstanding shares. Number third, treasury stock. Treasury stock. These are also known as issued shares, or you can say issued shares of the common stock held by the firm. These have been repurchased by the firm. These are also issued shares. But what is the difference between outstanding shares and treasury stock? That they are not available in the market. They are already issued but not available in the market. Why? Because this is repurchased by firm, and these are available into the company stock, not in the market but in the company stock. So that's become the treasury stocks. So this kind of stocks which can be issued by the firms. So the last one that company can shares is issued shares. As name suggests, issued shares. So if you remember, outstanding shares are also issued shares, treasury stock are also issued shares. The difference between both of them, that they outstanding shares are available in the market but treasury stocks are not available in the market. Why? Because they are repurchased by the firm. So treasury stock would only be available into the company stock, not into the market. So issued share, as name suggests, these are also issued share. And what kind of a shares it could be? These are the combination of outstanding plus treasury stocks. Okay, so these kind of stocks known as issued shares. Shares of the common stocks that have put it into circulation, the sum of outstanding and the treasury stock. Normally we said this is IPO, mean initial public offering. What does it mean? Initial public offering, like outstanding, when you offer it to the public that anyone can buy these shares. Okay, but later on it would be transferred into the company stock because of the treasury stock. So IPOs, so these are the IPOs. IPOs mean first you will offer to the public that you can buy all these shares. Then the terms we were discussing is dividend. What do you mean by dividend? Dividend refers to the reward. It could be in shape of cash, it could be shape of stock. Okay, that company gives it to shareholders. You can say rewards, it could be from profit and in shape of shares. For example, if you buy, let's say 50 lakh, if you are investing 50 lakh into a company stocks, and you have 10,000, just an example, you have a 10,000 shares of the company. At the end of the year, it might be possible company just wanted to give you a reward, they may give you 50 more shares. You can consider it as reward, and they may offer you in shape of cash. So both kind or the both shapes would be considered as a dividend. The last is, what is the difference between debt and equity? We already have a discussion that what is the difference between both of them. This is something you borrow loan, and this is something you hold. If you remember in the accounting, we have an accounting equation. Accounting equation said assets is equal to liability plus honor equity. Okay, so what you will do when you will deduct liability from assets, you would get your equity. So same, the things you have in hand is known as your equity. Okay, so what is the difference between debt and equity? Number one is the voice of the management. Voice of management. Now, in debit, you would get interest, and in case of equity, you would get dividend. Okay, so voice of the management, debt, they will give you interest and then their game is over. However, the people who hold the common stock or the common equity would take the part into the management. So management would delightly to hold or to wanted to hold the equity or to wanted to invest into the stock of the company. Number second is claims on the income and assets. Claims on income and assets. What we were saying, that when you have a bond and whenever you are in the position of the debt, the ultimately you would receive interest and then your game is over. However, the people who hold the equity, who have an equity and who hold common stockholders would claim on income and assets. As I told you, why they are claiming on the assets, because they are or they become the owner by holding common stocks. Okay, so that is the difference between the debit and equity. The last could be maturity. Okay, is maturity. Maturity means lifetime, or you can say time period. Okay, so people who hold the debt, it would be for a specified time period. For example, for a 5 years, could be 10 years, and could be for a 1 year. It could be anything, but you still have some kind of a specific time. But equity for a long lasting. This is for a long time period. So that is the difference between debt and equity, and these were just